For a brief moment last week, mortgage rates fell below 7%, but the good news remains that mortgage rates have been in an uptrend since the beginning of February, and last week that trend finally broke. New listings data has been slowing down for 3 weeks in a row. New construction communities are selling out too quickly and starting to limit their available inventory for sale, and as of last week's census report, builders are seeking less permits to build new homes at this time, which means less supply in the future. We're covering all of this and more, as well as what it means for you in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties, as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that is in the description below. Okay, today is May 20th. Let's see what the data is telling us. And if this is an old video, you can click the playlist here and it'll take you to the latest weekly market update. Okay, first up is market news. According to a report released last week by the Census Bureau, home builders are happy to just complete their existing pipelines and are not seeking as many permits to construct new single-family homes moving forward. And this is the first time since 2022 when rates went up over 7% for the first time. It's the first time since then that both 5-unit permits, that is large complexes like apartments, as well as single-family permits, are both dropping at the same time. And this is because mortgage rates are simply too high. So total housing permits in April dropped 3% from March and 2% from a year ago. And while this may not sound like a big deal, 3% in this case is equal to about 44,500 housing units. What I want you to hear in this is that the housing shortage is not going away anytime soon. And in order for prices to come down, according to the law of supply and demand that we all learned about in economics, either demand will have to decrease even further than it already has, which is already at record lows, or supply would have to increase drastically. So if builders are making less supply, it seems likely there's not going to be a flood of supply to bring prices down. So if supply is not going to increase, then if you want prices to come down, you're betting that demand is going to decrease. But in reality, everyone is just waiting for rates to drop. The minute rates drop, demand is going to increase drastically. So if demand increases drastically and supply, even if it just stays the same, prices have to go up. That is the law of supply and demand. I didn't make the law, I'm just telling you the law. And so far, new construction has really been the saving grace that has kept home prices from getting out of control even further. In fact, total housing completions picked up significantly in April compared to March, increasing by 8.6% to 1.623 million units. This was the second largest monthly figure in 15 years. So a ton of housing is being built and has been helping prices from going up faster. But looking forward, as of now, it seems builders are going to be making less units. Now, this is not the end of the world. It's just one report. It happened while rates are high, and there is still a backlog of homes that are currently being built. So in the short term, it's likely you're not going to feel this too much. And also keep in mind, mortgage rates just broke down from a nearly 4-month uptrend, getting as high as 7.5%. So this report we're looking at is from April, when much of the month rates were around 7.5%. So it's no mystery, if you're a builder and rates have been sitting around 7.5% for weeks, you're going to have less incentive to start building more homes. So just like everything else in this market, it's totally dependent on rates. When they come down again, I do expect builders would continue filing new permits. And I know at least one person is going to hear this report and say, wow, if the home builders are slowing down permits, that must mean there's no demand and the housing market is finally about to crash. But that is not even close to reality. I can't speak for the national market, but here in the Dallas-Fort Worth area, the market is crazy hot, especially in new construction, but you won't be able to tell it if you're just looking online and seeing the available inventory. A lot of that inventory you see in these new construction communities, they are not allowed to sell. They're not actually available for sale, even if the homes exist and are listed. Builders are actually restricting their available supply because they are selling too quickly. And they know they can get a lot more money out of these homes if they can just wait until rates drop some. As I said last week, one of the builders I spoke with, when they planned this community and the homes that they were making right now, they were planning to sell 8 homes a month. And in reality, they've been selling 20 homes a month. In other words, they did not build enough supply to keep up with the demand, so what they're doing now is restricting the number of homes that this community can sell. And this is happening all over the DFW Metroplex, so even though they've already started these homes and want to sell them, they can't continue selling at this pace or that community is going to sell out too early. So they have homes that are currently under construction that they will not let anyone contract because they know every day we're getting a little closer to rates dropping, and they want to have as many homes as possible available to sell when that finally happens because they know that it's going to mean prices are going to go up and they're going to get to stop spending tens of thousands to buy down people's rate on every home they sell. So they're totally fine, even though these homes are being built, not selling them, because the bet they're taking is that rates are going to drop sometime in the near future and they're going to make a lot more money. Okay, moving on. Starting with national housing inventory, this week we had an increase of just 9,726 homes for sale in the U.S., which gets us up to 578,016 homes available for sale in the country. For reference, the all-time inventory bottom in 2022 was 240,000 homes for sale. The peak of last year, we had 570,000 homes for sale. And this same week in 2015, we had about 1.124 million homes for sale. So the good news is we are just above last year's inventory peak. So that's great news. And we're up more than double from the 2022 absolute bottom of the market, but we still need to almost double again just to get back to a normal market. So it's happening very slowly, but you can see we are headed back up. It may take a few years to get to a normal market, but we're headed in the right direction. Now, the only thing I'll say about this is we are headed in the right direction with mortgage rates above 7%. What do you think is going to happen to this supply if rates drop? I don't know, but I think it's going to go up way slower if it even continues going up. Because of course, low rates is going to bring a lot of demand. Okay, now we're looking at new listings. So basically all year we've been tracking pretty close to 22's numbers, and that was great because as you can see in 2023 we had a horrible year as far as new listings. Though you can see the last few weeks, for 3 weeks straight, we've been getting lower and lower on the weekly new listings. And we are now significantly below where we were in 2022. And actually, this week we had 16,282 less homes listed than the corresponding week in 2022. And to get out of this housing shortage, we don't just need to match 22, we need to blow past it. So the last 3 weeks have not been looking good. So again, if the question is, where is all of this supply going to come from? It's not coming from new listings at the moment. The best chance of supply we have right now is high rates, meaning higher days on market, giving inventory time to stack up. But in order to get out of the shortage, it's not coming from new listings right now. Now, the last thing I wanted to show you is the spreads. I talk about the spreads a lot. I don't explain it enough because I know for some of you, this is the first of my videos you've ever seen. But whenever you hear me say the spreads, what I'm talking about is the difference between the 10-year treasury rate and mortgage rates. These two numbers go hand in hand. This is how mortgage rates work. You're a bank and you've got tons of money. Your options are you can get a set return that's super safe from the government at whatever the 10-year treasury is, or you can get a return that's roughly 2 to 3% higher by taking on a little bit of risk and lending that money to someone for a mortgage. So the spreads are simply how much more are banks charging to someone who wants a mortgage compared to the 10-year treasury yield that they could get. And that's where mortgage rates come from. If it's a time where the bank feels it's more risky to lend out the money for mortgages, then the spreads will get worse. That means they charge a higher premium to lend for a mortgage compared to what they could get for the 10-year rate. So if they think there's more risk, the spreads get worse, mortgage rates are higher, even if the 10-year rate stays the same. And of course, if they feel there's more economic certainty and they're safer lending out to mortgages, then the spreads will get a little better so they can issue more loans. So all this is showing here is in 2022, you can see the spreads were much better. In 2023, they got really bad and were about 3% higher than the 10-year treasury rate for a lot of the year. And here in 2024, all we're showing is 2024's spreads are much better than they've been in 2023. But just to give you an example, right now we're in the middle of both at about 2.57%. But back here at the beginning of 2022, the spreads were as good as just 1.57%. That means whatever the 10-year rate was, just 1.57% above that, that's what mortgage rates were. Right now we're at 2.57. So if the spreads today were as good as they were back in January of 22, that is a 1.57, mortgage rates would be a full 1% lower than they are right now. Even without the Fed touching a single thing, doing anything to do with rates, if all that happened was the banks felt economically certain to where they were comfortable taking a lower return because they felt it was going to be more certain. Mortgage rates could be a full 1% lower today. So last week, instead of getting to a 6.99, we could have been at a 5.99. And nothing needs to happen with the Fed, literally just the spreads getting better. So I say this to give you hope. Everyone's always wondering what the Fed is doing, what they're going to do, but just know mortgage rates can get better significantly by a full 1%, even without the Fed doing anything. And the good news is, so far this year, we're doing much better than 2023. And even just getting back to where we were in 2022 would bring at least, 0.25 to 0.5% better mortgage rates. So it's not going to take a ton. It's not even going to take the Fed for us to get better mortgage rates, or at least it doesn't have to. Speaking of which, let's go look at mortgage rates. We started last week at a 7.12. We got as low. There it is, that 6.99 for one brief moment. We were right under 7%. We bounced back up, ending at 7.09%. Now let's look at the 10-year Treasury chart. This is what I'm talking about. We have been in a trend since really the end of January. You see, we've been following. Anytime we touch this line, we continue up, okay? When I say we broke out of that trend last week, that means finally, we did not bounce off that and continue up. We broke down. Now, that doesn't mean we're going to go straight down. We could have a period of sideways consolidation before the market decides if it's going to go up or down. But when you're in an uptrend, step one to it ending is it has to break down from that trend. So at least that has happened. So we're in a good step one. And you can see these trends can go for a very long time, and they can even accelerate. So here we had a trend going up, and then it accelerated up to where it had a new, even faster trend. And then once it broke down from there, it came back down to the original trend. It took a small bounce there and then continued down significantly. Then you have a period of indecision. That was right here. And then we had a brand new uptrend, and now we broke down. We don't know what's next, but we know at least the trend has broken for now, which is welcome news. And then I want to show you on Friday, we closed at about a 4.42, just to show you what the spreads look like. The 10-year Treasury was about a 4.42, and as we just saw, mortgage rates that day were a 7.09, which means on that day, the spreads were about 2.67%. So the actual mortgage rate average was about 2.67% higher than what they could have gotten on the 10-year Treasury yield. So again, if the spreads were as good as they were at the beginning of 2022, mortgage rates would already be down at 6%. Okay, now moving on to mortgage purchase applications. This week we saw a 2% decrease in the number of people applying for mortgages. And as you can tell on this chart, we're basically just going up and down, 2% up, 2% down, 5% up, 5% down, but we have been just stuck pretty flat right here. Very small moves, very little change in demand. And what you need to see here is demand is down literally 37% from where it was in 2022 and even about 14% from where it was in 2023. So when we talk about low rates would bring more demand, what I want you to imagine is what would the market look like if we even just got back to 2023's demand, which is 14% higher. But what do you think the market would look like if we went all the way up to 2022's demand levels, which would be 37% more buyers in the market right now? When I'm telling you we have crazy low demand with these high rates, if you think that prices are going to come down, you're thinking this number is going to get even lower, like significantly less demand. It is way more likely that demand is going to go significantly up once rates drop. So just ask yourself, if housing demand were 37% higher like it was in 2022, what would housing supply and prices look like? Because that to me is the more likely next scenario compared to hoping that this demand is going to drop off to zero. Okay, before we move on to the local market data, if you're considering buying a home in Texas in 2024, two things. One, if you want to be a master of the home buying process here in Texas and know everything there is to know, I've released two courses. One is for new construction, one is for pre-owned homes. And like I said, these will teach you literally everything you need to know about the process, everything you need to look out for. You will be fully educated if you take this. And number two, I've developed a max affordability calculator. Hundreds of you have already used this, and this is a tool I developed that will very quickly and easily help you get into the ballpark of how much house not only can you afford, not only would you get approved for, but how much should you actually be paying for a mortgage based on your personal financial situation. It'll give you different options to review. It takes into account everything all the way down to your tax bracket. And I'm actually working on an update for this calculator, so it should be getting even better hopefully next week, maybe 2 weeks from now. But getting pre-approved is a hassle. especially if you're not even sure you want to buy a house or not even sure that you could possibly afford one. You don't want to go have your credit run and submit all your documents. So this calculator is your shortcut to seeing what you could reasonably get approved for, what those finances are actually going to look like based on your personal financial situation. So if you're interested in any of those, the links are all down in the description. Now let's move on to the local markets. We're starting with the MLS data, starting with Dallas County. We had 597 listings last week. That's 48 more than last week. 382 closings. That's 60 more than last week. Of the homes that closed, 108 were immediate sales, meaning they contracted within the first week. That's 24 more than last week. 331 under contract. That's 38 less than last week. In total, there are 2,460 homes either under contract or in pending status. That's 68 less than last week. Now moving on to Collin County, 438 new listings, 45 more than last week. 262 closings, 12 more than last week. 80 immediate sales, that's 38 less than last week. 244 went under contract, that's 15 more than last week. In total, there are 2,118 homes either under contract or in pending status. That's 20 more than last week. Okay, let's move on to the Market Action Index, starting with Dallas County. What the Market Action Index is it just takes into account all of this data and puts it into one easy-to-read graphic with a number. Anything a 30 or below is a buyer's market. Anything above that, we're just asking how much of a seller's market are we in. Dallas County is still a strong seller's market at 45. And all we're using this data for is to see what is the trend and are things looking normal. So as you can see, this week we did have a drop in prices and median list price as well as new listings. Median days on market remained the same. Number of homes having a price decrease, a small tick up. Again, this number should be going up through November. Inventory starting to climb. That looks good. Although, let's see. Yeah, inventory definitely looks like it's starting to climb. 786 up to 902. So that's good news. And the thing that I'll say when we're looking at the prices and you see, oh, it went from 445 to 440. Well, that's 1 week data. What we're here looking for is trends. So if we go look at the trend, as you'll see, the 7-day, that's the number where we saw a drop. But if you look at the 90-day, which is a trend, this number is clearly going up. So the trend is still up. Everything looks normal. Don't be surprised when you see sharp drops like this. As you can see, things go up, things go down, but what we're looking for is the trend. Now looking at the same thing in Collin County. Collin County, you can see, has been trending up. It also had a drop in price this week as well as new listings. They had a small tick up in days on market, so now both Dallas and Collin are at 35 days on market median. Number of homes having price decrease climbing there as well. Number of homes having a price increase is still dropping. It got as high as 10%. It's been dropping and now it's been more around 7%. So that's probably like 25% of new construction homes having a price increase every week. Their inventory as well having a smaller tick up, but it does look like we are, yeah, that's about the highest it's been all year. 3242 was the next peak, and we're barely above that, 3247, but inventory going up. That's good news. And then of course, if we look at the median list price trend in Collin County as well, it's obviously still trending up. So don't get thrown off by the weekly data. We look for trends. And now we are going to the top 10 ranked charts of the hottest and coolest cities and zip codes. The zip codes, however, do not seem to be loading today. But these are the top 10 ranked. Let's start with the hottest cities, and these are ranked using the Market Action Index. Remember, anything above a 30, we're just asking how much of a seller's market are we in. So what changed in the hottest markets this week? Louisville heated up 2 and came back in at the #1 spot. Coppell cooled off 1. Carrollton cooled off 1. Grapevine remained in number 4. Lancaster heats up 1, Plano cools off 1, Richardson heats up 1, Ferris cools off 1, and Garland and Grand Prairie remain at the number 9 and 10 spots. Sadly, we have no zip code, so let's move on to the coolest market. Van Alstyne remains the only buyer's market in all of Dallas and Collin County, and actually Van Alstyne, Lavon, and Prosper all remain the 3 coolest markets. Then Leonard cooled off 1, Blue Ridge heats up 1, then Salina, Nevada, Rockwall all remain in their spots, and then Royce City and Farmersville switched places this week for 9 and 10. So no one jumped on or got knocked off. Very little change in the coolest markets, a lot of change, small changes in the hottest markets. As always, if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. All of my contact info is down below. Thank you for watching. I'll see you in the next video.